She is serious, yeah. Okay, and here we are. Just waiting for everyone to tune in with us. Okay. And we have. Okay. Right, we're just waiting for someone to pitch up. Let's see who's going to be in for this session. Okay. It being 5, so we'll give everyone a couple of minutes. And I think we have a few people here. I think we have one who's joined in. All right, let's get in. Oh, in fact, we have a few more. Let's go. Okay. Right, fantastic. All right, so I think we have a few people here who are going to be. We'll just give it, as I said, we'll give it about 5 minutes. Give us a shout out where you're joining us from. Give us a shout where you're joining us from. And where you are with us, joining us from. Because today we're going to be going through something rather interesting. Good evening, O'Brien. So we're going to be going something rather interesting, and I think this is a question I actually pitched up because people kept on asking me as we kept on talking about this this week. Like, even how do you calculate how much your money has actually made? And there is a calculation that's here, and we thought it would be a good idea for people to know it as a preview to our weekend webinar tomorrow, where we're going to be talking about comprehensive retirement planning. And that's something that we wanted to get to everyone today. Comprehensive retirement planning is extremely important for everyone, because everybody looks at retirement either with fear or they pretend it's never coming. So that's what
that's the point of Nyomba, pretending it's never coming when they know it's coming. Yeah,
they'll just say, no, it's not happening, it's not happening, and then God says you're living until 80, just so that you can see what happens when you say
You're
stuff
not
like
gonna
it's
die
not happening.
soon. Yeah, yeah.
And obviously, this being some important stuff, and this is stuff that is going to come in tomorrow. We're actually going to do more and more of this, but we just wanted to show you a snippet of something important. And to everyone else who's watching, please, as you said, give us a shout where you're joining us from. Where are you right now? Name, and what would you like to get out of this? Give us also your views on what you'd like to get out of this, because it's not just us doing this. I mean, it's you as well experiencing it. So what would you like to get out of today's session? You know that we are strictly sticking to the NAPSA formula for interest. How does NAPSA money make interest? What is their definition of the interest that it makes? And also, how does it add to you? How has it been performing? Those are some critical factors that we just wanted to go into as well. And also, we wanted to talk about tomorrow's event as well. So this stuff is actually streaming on some of our other points. You can see that we are streaming across multiple channels today. Yes, we have upgraded people, but we are streaming across multiple channels today, simply because we wanted to make sure that we could catch as many of you as possible. And this is important information. Well, as our country has grown to know that lovely statement, very important. This is very important.
Very much.
Very important. Okay.
So guys, I'd like to begin by saying I want to know where you're watching us from, and if you've not yet registered for the webinar tomorrow, this is the time you can register. We're gonna share some numbers that you can call us to ask live questions, and if you want to come live on the screen after the presentation to ask questions, there's a link in the screen that we can come live on the screen, and then we'll get to converse. Yeah.
Okay. So I think we're getting close to that point, and I think we've given it about 5 minutes. So I think this is where we can actually kick off. And for those of you who are with us, thank you very much. We just wanted to give you a quick recap again on what's going to be happening tomorrow, the weekend webinar, and linking into this. Shadrach and I have been saying as important as you may have seen that we put up some information earlier that the retirement that you want and the retirement you desire and deserve is not going to drop into your lap. It's going to be a result of planning, consultation, and hard work with people. So remember that right now we have a situation where only about 3 to 6% of Zambians are actually preparing for the retirement they think they really want. And we're talking about working Zambians. We're not even talking about people who are unemployed. We're talking about the employed working people, or at least the self employed people. Of the 3 million workforce that we have, no one is really putting the effort and trying to figure out what kind of retirement. And the reality is, NAPSA alone is not enough. I know today we're giving you the NAPSA interest data, but NAPSA alone is not enough. You have to have the right plan, and that doesn't happen by accident. And we've seen full steam that when people don't have a plan for retirement, when they're younger, they feel like it's okay. Even though they should be getting started. But the older they get, every single year they add on, they start thinking about that dreadful day when they'll actually have to retire. And they're thinking, what's going to be of me? What do I have? What am I going to be doing? Some will try and convince themselves they won't even see that day. And those are probably the most likely who are going to see that day. But it does create a feeling of fear and anxiety amongst many people. And I've seen it especially, Shadrach, when people hit 50. When people hit 45, 50, they get very scared, especially if they haven't started. But I'll tell you that it's not too late. So to rid
Yeah.
yourself of that fear, what you want to do is you want to get expert guidance. This is what we're here to try and offer you: expert guidance on what you can be able to do to build the retirement you deserve after so many years of hard work. Whether you're an entrepreneur, whether you're self-employed, whoever you are, we're trying to give you that point as well. So our mission is to make sure that we give you we improve the quality of financial living and also the quality of retirement in this country. And as experts, we have customized and worked on the 4 bucket strategy that you are going to have to employ, and the cash management and budgeting strategy that comes along with it. Now, I know a lot of you have gone and said, look, we've tried it ourselves, we've invested ourselves, or I've got NAPSA, I've got this, but you know that that fear is not going away anytime soon. And maybe you've tried saving and you're not being consistent. Maybe you've tried investing and you're thinking you're not getting it correct. You're missing this, and you're trying to invest and not getting there. So we are hosting, with only 100 slots available, the weekend webinar. This is one of the first. This is the first of many. The weekend webinar with only 100 slots available, where we will be covering things like the 4 bucket strategy, the retirement calculations that you're going to need, goal setting. We call this the high five goal setting of retirement, and many other things. Plus, we will also allow those 100 who are in there to bring their issues. Like if you've got a live issue that you're going through in your retirement calculation or in your finances, you're able to bring it. And Shadrach and I will bring our plus 20 years of combined experience to come and solve your problems. Now, why do you want to work on a retirement plan, people? It helps you make the right financial decisions, and it helps you reduce financial waste. It helps get rid of that stress that you have about growing older each day and knowing that one day you may not have the ability to earn, so you want to own. It helps increase your precision of your decision making. It helps reduce financial problems even in marriage, because joint financial planning, especially for retirement, is a very good thing, especially in marriage. It helps you save your kids from being their black tax. It helps you become a good grandparent, and it helps you continue even your social giving that you'll be doing even at work. Now, remember, Shadrach and I together combined our consulting hours, or to our combined hours. If you want to spend 2 hours with us, you have to be willing to shell out 7,000 kwacha just to spend 2 hours with us. But we're giving you this opportunity to come into an enclosed room of just less than 100 people for 250 kwacha to be able to get the same experience. And remember that we've trained over 3,000 people, families and individuals, in family finance, investor education, and wealth advisory. So at this point, you can come in. As I said, there's only 100 slots remaining. The numbers are below. The numbers to make a payment to 250 kwacha to are 0977964002 and make that payment by Saturday, so that you can sign up and we can have you in our session. And also for those who are in MTN, 066797 434, the numbers are scrolling below. So that's just an introduction before we get there. Shadrach, I don't know if you have any comments before we start coming. What everyone is here for, learning how to calculate the interest on your Napsa contributions. We have a formula that's here for you, and that's going to be that's what you really came here for. But we're giving you the heads up. This is the preview. There is a lot more that's going to be in the weekend webinar on comprehensive retirement planning. A lot more. So Shadrach, before we
Yeah.
take off, anyone?
Before we take off, I think I just want to mention that retirement, guys, is a reality that the fortunate ones cannot avoid. All right. Some people think they're gonna die soon. No, you don't know your future. You're gonna live longer. All right. And unfortunately, Munyomba, many of us don't give this potential section of our lives much time to think about. We have continued to live life as if there is no retirement. All right. We live as though there is no tomorrow. And perhaps this part is so because maybe in our families we would not have people that are good examples, those that planned well for their retirement and how they have lived to set a precedent for us that have come before them, that have come after them as a way of preparing for retirements. So what we want you, our audience, to understand and to know is that after all your strength fails you, all right, because you're going to grow older, and as you grow older, your strength reduces. You will not be able to do the same things you're able to do right now. The only thing that is going to save you when that rainy day comes is your retirement. This is why it's extremely important, guys, that you begin to prepare for your retirement now when you have the strength and the capacity to do so. We have countless successful men and women, guys, whose retirement time is basically hell on earth, right? Because no effort was given to the preparation of life after retirement. People squandered their money, they bought vehicles, and then they sold them, and now they are old, they are depending on younger ones to start now stressing, supporting them. All right. So, guys, it is a pity that many of us are blinded by a culture that does not support ideas of retirement plans. That's just how sad it is, remember. Right. Our culture promotes the view that children are our retirement investment. Now, this must be corrected because our generation, all right, our generation has been exposed to information. We have been exposed to knowledge. All right. We can't be living like those that came before us. Us now, we don't want to be caught in the web of dilemmas, confusion. We have a chance now to begin to think about our tomorrow, about our children's future, about our own future, because we have the capacity to do so in this time and age. So, I just want to mention here, members, that whether we have children or not, I want you to know that our children can assist, but that is not their primary obligation to keep on taking care of you up until you're going to die. Can you give them a space? Because they're going to marry or get married. They have their own children. Now, imagine you always asking money from kids. It's quite stressful and it's not nice. You may even end up losing respect to your in-laws because you're always asking them. So in the end, the children are failing to visit you because when they come, it's like they're coming to sort out problems. So guys, with such sorts, we shall have more healthy and stronger family bonds if we prepared for our retirements. In my line of work, I talk to couples every single day. And I'm going to tell you something I've noticed about couples that plan for their retirement together. They are chains of love, but they are strengthened. Right? It is like they operate as one person, but because they have something to look forward to. They have reduced financial fights because they have a strategic plan that they've put in place that is guiding them through age and age until they grow older together happily. All right. So when you begin to plan for your retirement, either with your spouse or on your own, it gives you a sense of relief from fear of the unknown because at least you know. Like I always give an example. Imagine you are broke at home, but you have food, you've paid the rentals, everything is okay, you have some money put aside as for emergencies. There will be no much stress because you know I'm broke today, but I'm comfortable because I've saved up some money somewhere. If things went to the west, I'm gonna go and tap into that fund and I'm gonna pay my rent. I'm gonna eat just fine. So, guys, Mnyomba and I are here today to try and help you calculate, all right, using the Napsa calculator. That is actually one of the things you will never see anywhere else.
Yeah,
Mnyomba
because
has
we
worked tooth and nail, guys, to be able to come up with this one. It's something you won't find just anywhere. This is just considered a gift. So I want to take you through these calculations and I'll leave it up to you. So guys, we thank you so much for joining us. You guys are doing the most with your time and we wish you the very best. Enjoy this presentation.
Thank you very much to everyone. So thank you very much for joining. I will say that yes, Shadrach is correct. The NAPSA calculator we're just about to show you is actually something that was created firsthand. It was done with a lot of research and it's done with a lot of testing and has been tested on a set of clients to be able to show you what the actual true value. Now, why would you want to know the true value of your NAPSA to date? There are two particular reasons. One is, and you want to be able to know the true value of your NAPSA, inclusive of interest. One, because that actually affects its NAPSA has survivor benefits built into it. Should you pass away, it's actually something that your children or your people who you've actually registered on NAPSA, so be careful who's registered there. Should you pass away, those are the people who actually inherit it directly. And then secondly, in addition to that, it also affects the kind of benefit that you'll be able to get. How much would you be able to withdraw? How much would you be able to get if you passed the 180 contribution threshold in terms of the amount that you'll be able to pay on a monthly basis, your pension? Now, the amount of pension that the money is able to acquire, or the prospective pension that we'd expect, that number is only going to be given to you when we start. We'll show you how to calculate that in tomorrow's webinar, the actual pension number. But as for the value of the savings themselves that are sitting in there, today we're actually going to show this to you. So without further ado, let me go into the let me share my screen here as we go into the presentation today on this occasion. So hopefully everyone can see us, and please, people, sound check if you can hear us. Please inform us. It'll be very important if you can actually hear us or you cannot. So obviously this is the NAPSA, and this is part of our weekend webinar preview. Please inform us if you can see and if this is insightful to you. And let's go straight into a single slide that shows the interest formula. So now they work on something called wage indexation. That's what this is called, indexation to wages. And that simply means that your contributions, the interest applied to your contributions, is actually just a factor of the growth of wages since that contribution was made. So each contribution, so let's say if you contribute, remember you contribute 5%. Sorry about that. Don't know if we've got it still here. Sorry, let's just get that back. There we go, and we're back. Okay. So you contribute about 5% of your income, of your income to your NAPSA, and your employer contributes 5% as well. Those contributions, whatever year they were made in, NAPSA calculates what was the salary in that year, what is the salary today, or at least up to date. And if you divide the salary today divided by the salary, so it's the salary today divided by the salary, the average salary when you made that contribution. Now, not your specific salary, it is called the national average earnings. Okay, listen very carefully. It is called the national average earnings. What was the national average earnings? So how do they come to this number called the NAE? Okay, the NAE, and I'll show you the table of NAEs just now. The NAE is calculated every year when NAPSA is receiving those contributions that they're getting, the returns. The NAPSA returns are being filed. They're actually averaging and saying, what is the average person's gross income in that year? Okay, so remember, every time you file an NAPSA return, your workplace is actually putting in what's your gross income, and then it's calculating also how much the contributions are meant to be. So if you've done it even for some of your workers at home, and you've done it for your employees at your business, you'll notice this kind of information. So because NAPSA actually is getting this information, they're able to calculate the national average earnings each year. Okay, so now here it's put, obviously, when you're retiring, let's say you're trying to get a retirement benefit. This is obviously the year of retirement or death or invalidity, when you're not able to work. You know, like maybe you've gotten sick and you're not able to work anymore. And this is when you can access that benefit. Now they look at what is the national average earnings in that year. Now, for you who's tracking your earnings, you can pretty much do this every year now. You can look at what is the national average earnings at this point. So let's assume 2021. The 2021 national average earnings. So let me just quickly, and I'll go through the table of this, but the 2021 national average earnings is actually 6,109 kwacha. Okay, that is the average earnings they saw from all the returns data, and they were able to do this. They publish this number at the end of every single year. If you'll see, there's an announcement for it. Now, if you're looking at contributions made in 2022, you simply divide the wages, the national average wage in 2021 divided by the wages that were there, the national average age in 2001. And then you're able to find that this is a wage indexation factor of 24.91. What does this mean? It means that the value of your contributions plus interest effectively is whatever you contributed in 2001 multiplied by 24.91. Okay, that's it. That's how you do it, and you do that for every year. And you have to adjust it each year because the current NAE keeps moving up. The denominator, which is the year you contributed, does not keep moving up. So this is the national average in the year of contribution. This stays the same. When you made that contribution, there was already a national average. That was it. Then you look at the national average in the year that you're either reviewing it or claiming. That's the important thing. What are you looking at when you're reviewing it or claiming? And that number is going to continue moving. So here again, here's another example. Let's look at a person in 2021. The national average earnings is 6,109, but in 2011, when this contribution was made, it's 2,611, meaning that the wage indexation factor of any contributions made in 2011 is 2.9. So if you contributed 500 kwacha in 2011, you multiply that 500 kwacha by 2.9, and that is the value of your weight of your contributions now plus interest. So that contribution has earned that interest. So this is what NAPSA does. So what you'll find is that the best time for your NAPSA to grow is when incomes are growing. So when the economy is booming, jobs are booming, salaries are growing. If salaries are growing, NAPSA wages, your NAPSA actually performs very well. If salaries remain flat, your NAPSA performs very poorly. Okay, so this is what you need to understand. This is why maybe the last couple of years has been tough, especially the last 7 years. You've noticed that salaries have been flat, while salaries were good, especially between 2003 and 2013. Salaries were really moving at a fast pace. So this is your calculation I want you all to understand. It's just really you take the contribution of that year and you multiply it by the wage indexation factor, which is simply what is the average wage of that year divided by the average wage of the year you made that contribution, and you multiply it to the contribution, and that's the value. That's the current value of your NAPSA, and then you're able to do that to all your contributions. So now let's actually give you a method of how that looks. So just to switch now, we're going to move into what we call our NAPSA calculator of how that actually looks specifically for you and for anyone. So let's go to the table of. We're gonna go to the table.
Just before you proceed, I want to tell our audience that, guys, what we are presenting to is real information in real life. So if you are contributing to NAPSA, you may as well want to use this to see how much you have as of today. It's a very good example to help you do your NAPSA. Please continue.
You can actually take
your notes,
benefits.
Guys.
Yeah, you can take your contributions, and these are the actual numbers. So we and I'd like to thank the people from NAPSA who actually guided us in creating this. They worked with us very closely in creating this. This is the live NAPSA data now. We're actually utilizing. So the first thing you have to look at here is this is called the national average earnings, what we're talking about. And here it is per year, 2001, here it is 309.6. 390.6, 2002, 441.78, 2003, 518. And you can see each year, every year, at the end of every year, NAPSA will make an announcement. This is the national average income that we've seen this year from all the contributions we have assessed. So take a look at it, and it goes all the way up to 2021. This is the number I was giving you. And if you can look at some of these other numbers before, obviously, here are some of the numbers, we're giving you right now. Here's 6,109. Before it's 5,797. So you can see this is the national average of wages that they've seen through returns information. Now, I wanted just to quickly analyze this information for you to see what we mean by your NAPSA grows well when there's high salary growth and low inflation. Your NAPSA actually performs very well, but when there's high inflation and low salary growth, your NAPSA doesn't perform very well. So if you look at the wage growth, let's look at 2002. wage growth was 13%, but inflation that year was 26.7%. So it had a negative real return. So the contributions that year didn't do too well. But then if you go to 2004, wage growth was up by 56%, inflation was 17%. So NAPSA did well, or the NAPSA interest attached to contributions grew by 38.31%. So think about this the same as interest at a bank or interest at the stock market or interest anywhere. This is the interest that's actually being applied to your NAPSA contributions plus the interest from the previous year. So think about this as the compounding interest. So if you look between this period of 2003 up all the way up to 2013, you can see there was a lot of positive growth in the NAPSA years. And if you take the average between that period, there was an average. Sorry, if you take the average between that period, there was an average growth of about 11% a year above
Yeah.
inflation. So that's very good. That was even beating government bonds. Back then, government bonds were performing at about 5.6% above inflation. So it shows you that there was actually some good times, even with NAPSA, where it was performing well because wages were going up. Therefore, the interest on NAPSA contributions was performing even better than the government bond market, but not as good as the stock market. So now let's take a look, a step forward. Now, if you go up to 2013, you can start to see that inflation starts to pick up and wages slowed down. So you could see wage inflation here, 0.5%, 6%. You can see consistently wages were below inflation, except for a couple of years here. And if you take the data from 2013 all the way up to 2021, you'll notice that wages performed 4% below inflation. Okay, and this was the time the bond market has been doing about 11, 12%. So you can see that there are times when the economy is doing very well, when there's hyper growth and wages are doing well. When you're going through that push of economic growth, wages are doing well. And when wages are growing very fast above inflation, that means the interest applied to your NAPSA. So they don't take how the assets are performing and apply that interest to your contributions. They take how the wage or the job market is performing and then they apply that to your contributions. That's what you're looking at. So that's the key number you have to keep your eyes on. So now we have a little bit of sample data. But this, like I said, this is the full wage indexation numbers that you can see all the way through history. This is the historic all the way back from 2001 all the way up to 2021. And they're going to publish in December the national average wage by the end of this year. But know that this year it's 6,109. That is the number that was published by NAPSA. So let's look at sample data here. I have an employee here who has been working for a certain employer and started in 2010. Started in 2010. And obviously, the employer is contributing 5%, meaning they're going to contribute 5%. They started with a salary of 3,000 kwacha, and we're just assuming that they're going to be making 12%. Okay, every year they're going to have 12% growth on their income. The reason I've put that number is that's about the average wage growth that we've seen, about 12% over the historic period. So I'm just applying a simple 12% growth of salary every single year. That's what I'm applying here. So I'm going to take some of this data so that we can try and help us look at what this means. So let's take year one, 2010. All right, so that we're able to take a live track of it. And I'm just giving you how we can look at it simply. So we're going to take a live track of it. And the first thing I'm going to change here is change this date to 1st January 2011. I'm going to change this to 1st January 2011.
Guys, take notes, please. Take notes. Take notes. So this is real information, guys. Take notes.
Yeah, this is effectively live now. So as we put the sample data in, sorry, let me just put that back there. As we put the sample data in, we'll notice that this is employer one's contributions so far, and you can see this is just 2010. And what you'll notice here is they've taken the previous year's wage contribution, the wage indexation here, and they've taken the end of the year's one. And you'll notice the interest applied to each of these contributions is about 23%. This is called the wage inflation factor because 2,668 was the 2011 wage numbers, while this employee had deposited this money or contributed this money in 2010. So this would be like the end of year where they can now see the next year how they're doing. So 2011, this is us looking as if we're in 2011. So now the wage numbers that we're seeing here, as we said, 2173 is the base year. That's the year the contribution was made. That was the national average then. And the year that we're looking at in review, which is 2011, this you can see it's 268. So we're multiplying each of these contributions by 1.23, and you can see he's made 300 kwacha, 150 by him, 150 by the employer, that's 300. So that means that the indexed amount is 368, meaning that it's made 68.23 in interest. So you can see that Napsa contributions have made 368.23 interest, meaning that the total investment that this employee has done with their employer, that 5% taken off them, that 5% put in by the employer, is 3,600 kwacha, and the interest earned in this year was 818. So you can see how that works. Now let's change these numbers up and let's move to the year 2012. Okay, we're going to add in another set of numbers here. Let's add the next year, 2012. 2011. We're going to get the 2011 contributions, which only earned their interest at the end of the year. We're going to get 2011 contributions, and now we're going to add them into the equation, and we're going to move the year to say that this is 2012. So we've added that in. Now let's move this as if we're now in the year 2012. What do we see? Let's go back to these ones in 2010. Look at how this number has changed. The current year is now 2,934. Okay, now let's go to this. So we're taking the previous year, the end of the year one. This is 2,934. Here it is, 2011. But remember, we're pushing this up. This is the current year one. Okay, so we take the year before's end. So 2,934 is the wage number. And then if you go to 2009, effectively, you find that that's the base year for the 2010 contributions, 2,173. That's your base year. So now if you look at the wage indexation factor, it's grown. It's now 135. Okay, 135. So there's more interest that's been added to the old contributions. So you can see these 300 kwacha ones have now become 405, and they have 105 interest. But now let's look at these ones here where the contributions are 168, because remember the salary moved up. So now we have 168 contributions, so 336 each, so 336 in total. They are also being multiplied by only 110, because remember this has a different base year. These contributions were made in 2011, while this one is tracking, while the year we're in is 2012. So you can see that the contributions earned about 30 kwacha each. Now if you go to the top, so this is the value of it, 369. So you can see the contributions made about 30 kwacha each. Okay, so everyone just pay attention very clearly to all of that information. Now, and if we look at the top here, you'll be able to see that the total contribution has been 7,500, interest earned 1,650, because that's how much wage growth has actually stimulated index. So now let me just pull this person's whole data now, so that we can just go through it and say, let's say this person gets a 10% increase in their wages every single year for the next up until this point. Let's assume this person, it's October. Yeah, let's assume this person gets this. What is their money going to look like? So let's look. This person's wage by the end is 7,555. So that's how much their salary has grown. So let's go back to the top here. And now let's add in as if this person has done this contributions for this period of time. So you can see we've added in all this data. And by the way, this is our live calculator that we've been able to put through. So yeah, this is our live calculator that we've been able to put through. There must have been a glitch somewhere just here. Sorry about that. We do have live issues sometimes, live wire issues. But yes, let me just move away from some of the data here at the base. But what you'll be able to see, especially to some of this information here, let me just pull this up. What you'll be able to see is that, and I think the only mistake we made here, my apologies, is that we didn't upgrade the year. We didn't upgrade the year to 2022. So we have moved into the year 2022. So we actually have to do that manually for now. But we've upgraded the year 2022, and we've seen here that you see the current year has now moved to 6,100. So you can see that the 2001 contributions are multiplied by 299. The 2012 contributions are multiplied by 2.08. because of the difference here. So you see these base years are moving. So if you get to the 2013 ones, they're multiplied by 1.8. The 2014 ones are multiplied by 1.5. And you can see the numbers keep decreasing because as salaries are growing, the difference between the current wage and obviously the base wage is slimming down. So over this person's career so far, this person has worked 10 years. They've put in 7,000. They've put in 76,099 kwacha in total contributions, and they've made 33,000 kwacha in interest applied using this wage indexation formula from 154 contributions, which have now which sees their total NAPSA balance from the contributions of 7,600, of which half of that was just them and half of that was their employer. So this is half of that. So think about that. Your employer is adding extra money to you. That's the other thing you have to remember with your NAPSA. Your employer is actually adding extra money so that your 5% is matched by their 5% and therefore it grows. So if you think about it this way, this employee has really only put in 38,000 kwacha, and so far they've got a pension, they've got a retirement package of 109,000 kwacha. Okay, so it's not as minimal as you may think, because part of the whole NAPSA system is to double your contribution with your employer. So you are sacrificing 5%, you are saving 5%, but your employer is also adding 5%, already doubling your contribution. Then there's interest added to the top of those, and that's how we get to the number. Now, if you think about it, trying to take the money out yourself, and imagine putting that 5% out yourself, it may not be as easy. So these are things you also want to consider whenever you're doing this. So these are your calculations that you're doing. So when you look at the total interest earned by our friend Yobanda here, as we said, total interest earned on the total contributions is 7,600. But if you're looking at total gains, this is contributions of the employer plus the employee. But if you factor in the employee, this person has actually made triple their money because of that, because of the employer match. So also remember that statutory pension comes with an employer match. So does workplace in pension as well. We'll talk about that also deeply in tomorrow's. So I wanted to give another example. We've got a second person here. This person started work in 2001. Okay, so this is their data. So we're going all the way back to 2001, where this person started their work. Sorry, let me just correct that to 2002. The sample data is supposed to show all the way from 2002. And we're going to be able to now grab this person's data and to fit this into the box as well to show how much of an impact this has had for the person who has invested since 2002. I'm sorry, 2002. Yeah, so we're going to go up to today, up to this point of October 2002. Just remember that what we've got here in our table is a month and a year here. So let's go all the way here and let's post this in. And we're going to be able to see that there is a little bit of a difference here. So individual two, who has been pushing in money. Oh, sorry. Sorry about that. I think I just need to correct that. We kind of just made a little bit of an error there. So apologies, people. We just made a slight error, and this stuff does happen once in a while. We did add an extra column by mistake. So let's just go back and collect the data again. Sorry, this is just done a bit manually. But let's collect this data here because we did put in the salary one by mistake. That's why it was showing such a big number. Now let's put in this data here to try and look at what you should be considering for somebody who has been working since 2002. So let's get this number in again. Okay, and now we've got normal numbers here. So since 2002, Joe Banda 2.0 has made 261 more contributions. By this point, we're talking about somebody who should be getting a pension. But if you want to know the pension number, you're going to have to sign up to tomorrow's so that you can actually understand how they get to that calculation. This is something we've gone in deep. I'm able to tell people what their pension is so that they're able to plan and know that, okay, so when I'm retiring, this is the pension I should be expecting from NAPSA. So I'm saving and investing in my other three buckets. This is my target because I know NAPSA is taking care of this much income. Then I know what I'm going to be getting this side. So we've got that calculation to help you actually come up with a realistic outcome. So if you look at this person, you'll notice something that the wage indexation numbers of their 2002 contributions are much bigger. Look at the wage inflation number, 15%, because the average wage in that year was 390. Unlike the other one where the average wage was 2,600, the average wage this year was 390. And you're able to see that you multiply these 300 quarter contributions by 390. So total interest earned is 4,390 on this money versus the 300 quarter that was put in back in those days. So this is the interest that's being earned. This is real life data, people. If somebody came to me with this data of their wages, this would be the actual outcome. So as you're moving along, you can see the numbers are getting smaller and smaller, but you can see the people who started earlier, 2000, 2002, those times, with much lower wages then, they've got huge wage inflation sitting sitting on their data. So now if you look here, this data ranges from this point. You can see that the total contribution made was 195,000. Now remember, the employer throughout their whole career has only made 95,000 of that, 97,000 of that. Only half of that has been by the employer. The other half has been by the employee. So when you think about NAPSA, also think about the fact that you're earning interest by your employer giving you 100% on your money already. And then on top of that, what is the wage inflation that you're getting there? Now, the total interest earned effectively is 311,000. So look, the employer and the employee together have put in 195,000, but the contributions have made 311,000. So this person's actual balance is sitting at 493,000. So let's go to what end wage this person has, because when you go down to look at their end wage, this person is earning about 15,000 kwacha. Okay, so this person is really earning about 15,000 kwacha, yet they've actually been able to accumulate all of this. This is a person who is sitting there. So if they passed away at this point, that 493 can now be obtained by their beneficiaries, the beneficiaries to their estate, the ones that they've signed up. If they're talking about lump sums, which they're not going to be able to get, because at this point we're going to calculate the pension. But the point is, if it was a lump sum, that would be the lump sum sitting in there. And this was a person who has just cumulatively put in 97,000 kwacha throughout this period, while on top of that, because of the employer match and therefore the interest added to both the employer and the employee, that's the savings rate. So if you try and look at putting your 5% into another vehicle, it may not be as easy because you don't have an employer match when you're investing in those. So this is how you're supposed to look at the interest. So if you look at your total interest that you're actually earning, it's actually meant to be 97 plus that 300. So effectively, this person has made about 400,000 kwacha interest on their money. But this is the longer you invest. So this is the benefit to most people who actually stay in the plan for as long as possible, consistently contributing and so forth. We're also going to talk later on about the benefits of doing this as an entrepreneur. That's going to be in tomorrow's. The benefits of also building your own investment plan as an entrepreneur, and also the tax benefits. Remember, there's tax advantage to this as well. This is money that goes in. Remember that employer match goes in tax-free. Part of your money is also tax advantage. So remember that this is actually one of the most tax advantaged forms of savings as well. So when you're making considerations about how to manage your portfolio, these are things you should look at. And these are the things we're going to take you through tomorrow in a much more comprehensive fashion for that. But for now, this is actually our benefits calculator. And we'd like to thank the people from NAPSA who actually helped us put this together. And who actually helped us with the data and putting this together. And for any questions that we may take, Shadrach, I think for that point I am concluded. I don't know if we have any questions here as well.
Okay, so maybe before any questions, just to make our friends understand. So remember the last guy we dealt with, how much interest was he earning per annum on his contribution? Just total interest per annum.
So if you're gonna break down the amount of money that
even just a month, I want to use one of them as an example, just to help our audience understand what is going on with their money and what happens in real life when prices are going up. I want to use a simple example of the the CPI, Consumer Price Index, to show them what NAPSA does, what it is similar to in reality. Because this guys is an accurate live data from NAPSA right now. So we're able to tell you how much you have in pensions. If you came tomorrow and sit down with us for 2 hours, we'll make you understand how much you're expecting to withdraw. And you're going to know that you qualify to even get a lump sum. I think that's going to be fantastic. So just give me a heads up number, just one, either the total interest per year or just for one guy, so that I can show our audience how it is done in simple terms for prices when they're going up.
So the total, I'll give you the average interest per year for
Yeah.
the first person. The average
Yeah.
interest per year for the first person who was earning the NAPSA, the average interest, and I'll take it from 2010 onwards. The average interest they were earning was 9.17%
Yeah.
compound. That is the average
Compound.
compound interest annually on their contributions that were being made. So remember, this interest comes at the end of the year when they adjust that wage number. So the average that personnel who started work in 2010 was making 9.7% on average, 9.17%. So this is similar to putting your money in a bank and it's earning 9.17%. But the
Okay.
only other factor I'll take into this, Shadrach, which
Yes.
most
Yes.
don't consider, is we don't factor in the employer match. That's the part that
Yeah.
we don't factor in. Because if you're looking at the money they're making, remember that you have to add 9.7% on the total money plus the fact that your employer has doubled your contribution. So your employer has already given you 100% interest on your money. Then your NAPSA is giving you 9%, 9.17% on the total amount of money. So I don't know if everyone has taken that full load into consideration.
Oh yeah, so remember, that's a fantastic presentation. Guys, we may ask questions, and we are ready to answer your questions. But just a quick one. What Mnyumba is saying, I want to show you what happens in the process. Why you should come, and we help you how to invest your money. Here's the point. Mnyumba has shown us what happens when you're contributing in NAPSA. I talked about the employer match and things like that. Fantastic presentation. Now, guys, just in layman's language, okay? There we go. I have this example here, just in layman's language for you to understand how actually numbers are moving in the markets, and also just okay. So there we go. Okay, good. So I have this simple explanation. Guys, can you hear me? Please give me some feedback. I want to know if you can hear me before I proceed. Can you hear me? Are you able to get me?
I can get you very clearly, absolutely clearly.
Okay, okay, fantastic. So now I'm gonna go to this one here. So now, guys, look at this data here. So this one here is a simple example of what happens to your money, to prices in the market. So we are going to use what is called the consumer price index to show you how prices increase year in, year out. All right. So what I have here is not live data. So what I'm going to do, I'm going to use live data. So each year has got its own consumer price index. This is simply a price tracker or an index on prices to show an increase on all the goods and services purchased by households in that particular country in particular year. So now, what happens in practice is this. For example, I'm gonna use some live information here. In September, in August this year, before the price index reduced a bit where it is now in September, we are running at 364 units. All right. 64.87. This was our consumer price index this year. Now, let's go to what it was last year. Last year, the consumer price index was about 332.1, right? That was our price index for last year in 2021. Now we're in 2022, now in September. So now what happens is this shows you how prices increase. So let's say this is 2021. So I'm going to use this one as 2021. 2021, and then let this one be 2022. So if you get the difference here, when you see the difference between the 364.87, you remove the 332.21. I just want to get a percentage decrease or a percentage increase. So the difference there is going to be something like 32.87. You may want to clarify that the 364.87, and then you less the 332.1 is going to give you about 32.77. So what we have here is 32.77. That's just the difference. Now, if we get that difference, we divide by the 2021 base. So this is the increase now. This is the increase now. Now, let's find out the percentage. So the percentage, we're going to divide that 32.77 by the 332.1. So 332.1. If we divide that one by the 332.1, what you're going to get is 0.986%. Now, our answer here, guys, is let's say 0.968%. If you multiply that one by 100, it's going to be able to give you a 9.86 9.7%. 9 point, of course, 87%. So now, guys, look at how prices are increasing for goods and services. Your prices are increasing for how much? They are on average 9.87%. This is real information, guys. This is the 2021 data, and this is the 2022 data. Of course, today in September, there's a slight change. I just checked a few minutes before we started this presentation. Today, the CPI has reduced to about 363.89. It's about 363.89. This is what it is as today, right now, as we speak. Now, guys, I'm going to tell you something. See the rate at which goods are increasing, 9.87%. And then look at how much your earnings are increasing in Napsa. It's around the same. It's also about 9%, remember, right? We said 9% on average?
9.7%. But take into consideration
9.7%.
Yeah, I was saying, take into consideration that, and I always say to people, when you're thinking about workplace pension, always consider the employer match. Always consider
Yeah.
that your employer is already adding 100% to your money on top of the fact that there's interest being applied to it. Because if it was just you saving, that's you alone without the employer adding to it.
So now, guys, look at it. This is just the weighted average NAPS, as remember saying, take into account employer match. Now, think about it. If your money is earning 9.7% on average, and then the prices for goods and services are increasing by almost 9.8%. So this means that if you don't invest properly, before you know it, this money will have no real value. But because if you make a wrong investment, the rate at which prices are increasing is almost at the same rate at which you're earning interest in the bank, in your pensions. This is why you need to come through tomorrow, guys, to sit down with us so that we can be able to show you other alternatives that can help you earn a much better interest on your investments. All right, but because if you are increasing prices are going up at 9.87%, and then your interest on earnings about 9.7%, you're not doing anything. You are lagging behind, literally. This is why you see people say, you know what, the dollar has stabilized, but still things are too expensive. It's because the prices, all right, they are also increasing almost at the same rate with what you're earning in your savings. So you can't really feel the benefit. So come through tomorrow, guys. We'll sit down with you. We'll break it down for you. We'll show you exactly how you can prepare for that meaningful retirement. So what I'm showing you is simply in layman's language. This is not comprehensive data that can reflect everything about the consumer price index. I was just showing you to see how the index goes on average. All right. So I picked up the number from 2021 and the one from 2022 are August, because this one for September is about 364.87. It has reduced a bit. So there's a bit of some reduction in the price of goods and services in September. So now we're in October. I've not used that index, all right, for planning purposes. So guys, if you can come through tomorrow, we're going to sit down with you and be able to help you to come up with a better plan for your retirement. If you have any questions, Mbenda are more than ready to begin to answer those questions now. Remember, the session with us tomorrow for 2 hours at 20 hours is only 250 kwacha. You get to ask live questions. This is what I like about this arrangement, because we're going to be dealing with real issues from real people. You know, when we are here like this, we're giving you general information. But when you come for this advisory and consultation session, we're going to be giving you information according to your needs, according to what you're currently going through. For example, remember, I was giving an example. If you started working in 2005, we're going to sit down with you and help you to understand how much you have accumulated in your pension. Right now, we can help you to understand that. And then we give you an advice. Okay, you've accumulated so much from 2005 up to now. All right. Which one can be a suitable investment for you? All right. What other vehicles of investment are you able to invest in? For example, you say you qualify for a lump sum. We're going to help you. Okay, if you can qualify for this amount, which you don't know the specifics yet, we can give you an idea of what you can do to invest with that kind of amount. So, guys, this is take it as a gift. And by the way, the slots are moving very fast. People are already enrolling, so we are admitting to a few slots. Please, guys, there are numbers scrolling on the screen. They are down. Make a payment and send a proof of payment to the numbers attached, and then we will set you up to the class for tomorrow at 20 hours.
So thank you very much. I don't know if everyone finds this comprehensive. Please give us a comment below on how you found this. Thank you very much. Seppo has said, yes, this is very detailed. And these are the things that we try to help you understand properly, because we want to make sure one of the things that we found is that when people use advisors for information, they often find that they often find that they're much more in depth. And the reason why they're much more in depth is because advisors help you, and they're also much more resilient because advisors help you clutter away the emotions of decisions. Because money is a very emotional decision. Anything to do with money is very emotional. And we come in, we're very analytical, we're very critical, and that helps you somehow just see things from a different perspective. Because I know most people, like for example Shadrach, do not take into consideration the fact that your employer has given you 100% interest on your money already, just by contributing, and then on top of that there's interest applicable to that. So if I'm
Yeah.
telling you that the average, if I'm telling you that that you're putting in 0.5 effectively. So let me just put this so that we know what the average rate of return for that individual was, Shadrach. It would be a person who
Yeah.
is basically earning, let me just put this 0.997. People are doing live math here. So yeah, 0.9.71 divided by 50. This is a person, Shadrach, who effectively on your NAPSA contribution, because there's a statutory component of your employer putting in
Yeah.
that money, your money is making 119%. Okay, so think about it
Yeah.
this way: you've already been given 100% interest on your money by your employer, and then 9% on average. That person was making 109% on their money. Now, if we're taking into consideration the person, so think about it this way: your savings are making 109% because there's someone matching it. Now, the other component, let's look at the person who was working from 2002. They had experienced an average of 15% growth on money. So what they're finding is 115.94 divided by 50. So they're making 130% on their money. So it's just something that everybody always has to consider whenever we're doing these as well. And just to give you some extra numbers in the Shadrach, the person who had worked from 2002, they out of
Yeah.
if you look at the total amount they had, that 493,000. If you look at the total amount,
Yeah.
that
Yeah.
person effectively had only 17% of that money was the money that they put in. Only 17% was the money they
Wow.
put in. 83% was the employer, and then interest. So employer plus interest made 83%, and interest was sitting at about 63%. Then if you look at the person who had been working from 2010, only about 33% of the money sitting in their NAPSA was in terms of the real value, the today value of the
Yeah.
money. Only 33% of that was money they put in. The rest was their employer plus the interest component as well. So count your employer as interest on your money.
Yeah.
So look at it very carefully. Count your employer as interest on your money, because if you took that money and tried to invest it yourself, nobody's matching it. So your employer
Yeah.
is already giving you 100% on your money. And then on top of that, you're also making. So the longer you stay in, there's also those factors. This is just numbers, people. I know how people feel about this stuff, but this is just the raw, down to the point numbers you should be
Yeah.
assessing, so that when you're saying, when I have this 5% in my hand that's being taken out, where's the best place for it to go? Now, there's no other place. Like I said, you supplement your statutory savings by the fact that yes, your employer's matching it and you're able to put it. You supplement it with your other four buckets, your other three buckets of savings, which are going to learn what your other three buckets of savings and investment are in tomorrow's session. But as we said, the right pension does not happen by mistake. It happens through strategic planning, sitting down, going to sessions like this, and making sure you're doing hard calculations. And we're going to see if there's any questions here. If there are none, I think today we can kind of call it a day. So to everyone, the numbers are scrolling below. Those are the numbers that you contact. Tomorrow we're
If you
going to go.
can't type, the question is too long, you want to click on that link in the comment, you can come live on the screen and ask a live question right now. If typing is too long, you can just click there quickly. We admit you ask us a question live right now. There are so many links you can click. Even that one there can bring you live. That link from YouTube can bring you live. Another link from YouTube, another link from there. So there are all those links in your comment section that can bring you live right now and ask us a live question. What is the situation, so we can be able to understand what is going on? So you can also ask us that if you want to register for tomorrow's session. Yes, my friend. Okay, I'll be coming. Thank you. So if you want to register for tomorrow's session, guys, what you'll be able to do is that feel free to simply deposit your slots fee on that particular amount, on that particular number which is going on the screen, and you send the proof of payment. Yes, my friend. Okay, thank you very much. I'm gonna come. Okay, bye.
That's
Yeah,
the beneficiary to his Napsa. So everyone,
that's the beneficiary to my NAPSA, guys. That's the
that's the
beneficiary. It's like
beneficiary
the
to his Napsa.
CEO. Yeah, it's like the CEO. He will not stop calling
Okay.
you up until you look at him. That's the first. So, guys, Sepo, thank you so much. We're happy to have you here. It's always good to see your name pop up every now and then. We really appreciate, guys. Thank you so very much. Okay, guys. I think we call it a day for now. There are details already available. I've made posts. The slots are moving very fast, guys. Please do not miss out on this life-changing, webinar tomorrow at 20 hours.
All right. Thank you very much. And Shadrach, see you tomorrow. To everybody, see you there. Only 100 slots available. They are running out.
Not 100 million,
Don't
but
miss.
they have reduced.
Yeah. Oh, they were 100 slots available. They are now running out. So I hope
Yeah,
this was helpful for you, and know that this is only about 10%, 5% of what you're going to get out of tomorrow's session.
yeah,
So thank
yeah.
you very much to everyone. Have a wonderful day. God bless.